I'm Doris and I'm here to share with you about my stock account. Today, my stock account has made a loss of $1,703 US. US stocks closed higher on Thursday amid higher expectations for the Fed's tightening cycle. The Fed is betting hard on it. Wall Street warns that cutting rates are too late later this year. In my stock account today, I've made a total loss of 2.28%. Right now, the net asset of my account is $72,968.59. Today, SQQQ made a loss of 3.46% after the rise yesterday to $32.69. The market is closed mixed today. It dropped in the middle of the day and then rose a little bit higher in the afternoon. Dow Jones Industrial Average rose for 0.23% to $32,105.25. Nasdaq Composite rose for 1.01% to 11,787.4 points, and S&P 500 rose for 0.3% to 3,948.72 points. All the major stock indexes posted a small gain. The industries closed mixed, with internet content and other tech industries closed higher. The semiconductors closed with a gain of 2.45%. On the other hand, the banks and healthcare closed lower, and healthcare closed negative 2.13%. U.S. stocks closed higher on Thursday, led by technology stocks. Markets are still waiting for the Fed's monetary policy outlook. U.S. jobless claims data last week shows that labor market conditions remain extremely tight. U.S. Treasury Secretary Janet Yellen said the federal government will take additional steps to stabilize the U.S. banking system if necessary. On Thursday, the stocks rose more than 480 points in the morning, rise as high as 32,511.49 and falling as low as 31,864.74 with an amplitude of nearly 650 points. Treasury Secretary Yellen told lawmakers on Thursday that the federal government will take additional steps to stabilize the U.S. banking system if necessary. We have used important tools to act quickly to prevent the banking crisis contagion, Ms. Yellen said in preparing testimony to the House Appropriations Subcommittee. There are tools that we can use again. Setting regulatory guarantees for all deposits at Silicon Valley banks and the Signature Bank. Yellen said, the strong action we took has ensured the safety of American deposits. Of course, we are prepared to take another action if necessary. Some lawmakers have already discussed raising the deposit insurance limit from the current $250,000 per depositor. Ms. Yellen told the Senate Appropriations Subcommittee on Wednesday that the U.S. currently has no insurance package for bank deposits and stressed that the bank owners and bondholders are not protected by the government. Ms. Yellen's comments on Wednesday dashed the expectations that the government could quickly provide guarantees to prevent further bank runs and send the day tumbling for regional banks such as U.S. banks, especially First Republic. Stock market investors were still reviewing the Fed's monetary policy on Thursday. The Fed announced a 25 basis point rate hike on Wednesday, saying the recent banking crisis could hit the U.S. economy and suggests that tightening action to fight inflation may be nearing an end. The Fed statement removed FOMC members expect to raise interest rates appropriately. Ongoing increases will be appropriate, repeatedly used in the past statement. To some additional policy tightening is expected to be appropriate. The change in the language is interpreted as a sign that the Fed rate hike cycle is nearing an end. On the recent banking crisis, the Fed statement also reiterated they are prepared to adjust policy positions if necessary, and that the U.S. banking system is sound and resilient, and recent development could lead to tighter credit conditions for households and businesses and put pressure on economic activity, job recruitment, and inflation. The extent of these effects is uncertain. The Commission remains highly concerned about the inflation risks. On the Fed's move, Wells Fargo said policymakers underestimate how much and when the credit environment tightening would hurt the economy, and that the top risk over the next 3 months was financial instability, not inflation. U.S. authorities need to boost deposit guarantees, and the Fed need to cut interest rates. The 50 U.S. regional banks could fail. The E-Investment U.S. analyst Kelly Cox said, "The Fed's vote of confidence in the economy is good news, but it is also a reminder that inflation remains a major concern in policymakers. Investors believe that the banking crisis could put enough pressure on economic growth to ease inflationary pressures." But the Fed is not taking any chances. Monetary rates will likely remain high until we see a significant slowdown in the labor market. We've seen the dominant rate trade in the past 2 weeks and could also see the reverse soon. On the economic data front Thursday, the Labor Department reported a surprise drop in jobless claims last week, indicating that the labor conditions remain tight. In the week, initial claims were 191,000, down from 1,000 from the previous week and below the average market estimate of 198,000. The number of people receiving unemployment benefits rose by 14,000 to the total of 1.694 million. Another data showed that the new home sales unexpectedly rose in February, following the last month's downward revision, suggesting that the housing market began to stabilize after a volatile year. Sales of new single-family homes rose 1.1% to an annual rate of 640,000 to 633,000 in January. The government data also showed that Thursday, the median forecast for economists was 650,000 units. The latest data suggests that the housing market may finally take a hold after a rapid rise in mortgage rates last year. Even so, affordability remains a key concern for buyers, and the limited supply of housing in the market is also limiting sales. The Bank of England raised interest rates by 25 basis points on Thursday, raising its benchmark rate to 4.28 to 5%, the highest level since October 2008. Since December 2021, the Bank of England has raised interest rates by 415 basis points. The Fed is betting hard on it. The Wall Street warns cutting interest rates are too late later this year. The biggest highlight of yesterday's decision to raise interest rates by 25 basis points and its chairman Colin Powell's press conference was that market once again chose to ignore it. Traders were betting that the Fed would cut rates by at least 75 basis points at the end of the year, while Powell said it would not cut interest rates this year. Some investment strategists pointed out that Powell was only tough on interest rate cuts, while Fed officials were betting on the banking liquidity crisis and the resulting contraction of the credit environment is ultimately controlled and will not excessively danger financial stability and a soft landing of the economy. But just as Fed ignored the crisis in inflation in 2021 and started it too late in March 2022, the Fed may have misjudged it this time again. Even rate cut this year may be too late to ease the pressure on heavily indebted companies. As U.S. financial conditions tightened on their worst since May 2020, U.S. banks began to tighten lending standards across the board. Even if the Fed's cut rate, said Redmond Wong, a strategist at Saxo Capital Markets, credit spreads will widen and, more importantly, credit may not be available, making it difficult or costly for companies, including Asian companies, to roll over dollar debt. Key indicators show that U.S. financial conditions to their worst level since May 2020 early in the March, following the U.S. regional bank crisis and the UBS leaking acquisition of Credit Suisse. According to media reports, in the latest survey of senior Fed lending officers, U.S. banks revealed that they were tightening lending standards across the board. In other words, the impact of the current banking crisis should not be underestimated. Jay Bryson, chief economist at Wells Fargo, said Fed officials are calculating the risk and may sink the recent banking turmoil, while slowing growth will not turn into a broader financial crisis, and that the Fed thinks it has tools to contain the turmoil in the banking system and can deploy it efficiently and quickly. But given that the Fed and other regulators misjudged the situation in 2007, the Fed's internal consensus that it will not cut interest rates this year is not wrong. The Fed chose to raise interest rates and wait and see, mainly because the aftermath of the banking crisis is not fully yet felt. From the Fed FOMC resolution statement and Powell's press conference, the Fed will focus on curbing high inflation. Powell, this is due to it is difficult to judge how the banking crisis caused the soft landing expectations to change. So, Now judge how should cut interest rates. How should through interest rate policy to respond to the banking crisis also appear rushed. Some analysts said that Fed's approach is called wait and see, in contrast to nearly half of market participants before the meeting, betting that the Fed would not raise interest rates and wait and see. But the Fed financial market seems unable to wait. Future contracts backed on the benchmark U.S. interest rates in December to around 4.2%, combined with traders saying the Fed would raise interest rates by 25 basis points in May, representing at least 75 basis points this year. That was a dramatic shift from the market expectations before the banking crisis, when hotter inflation and employment indicators even led to some talking about raising interest rates as high as 6%, and this week's 50-point bet was certain. Why is the market opposite to the interest rate path? For being more worried about the credit crunch and the recession risks. In summary, traders, market participants, and analysts believe the risks of a credit crunch and the attendant downward pressure on the economy have led to a surge in bets on Fed rate cuts, Mr. Sheta says. Asian Pacific equity strategist at Nomura said, pressure on U.S. banks have accelerated the tightening of lending standard, which could lead to a recession. The tightening of banking lending standard could put downward pressure on credit creation and the U.S. economic growth in the coming months, accelerating the course of a possible recession. Indeed, the Fed itself is highly concerned about the potential impact on severity of banking crash pressures. The FOMC statement deliberately added a new paragraph to warn that bank failures could hurt the economy. Recent developments could lead to a tighter credit conditions for households and businesses and put pressure on economic activity. Powell also said in a press conference that credit crunch could replace monetary rate hikes, but Mr. Powell's comments highlighted the uncertainty about the spillover impact of banking problems on credit conditions. On the one hand, the reduction in lending could lead to a lower consumer spending and demand, which means that the monetary policy may have to do less work. At the same time, banking pressures could also have a very modest impact on the economy, and inflation will continue to be strong, which in case more interest rates cannot be rolled out. Financial conditions may be a key determinant of future interest rates, and markets may reduce the importance of economic data in the short term. Nationwide Life Insurance chief economist Casey Boschak said, combined with Powell's admission that the Fed was considering not raising interest rates in the wake of banking crisis, the FOMC seems very uncertain about the extent, duration, and the impact of credit tightening. At the same time, it suggests that the given risk of deflation from a significant credit contraction, financial conditions could become a key determinant of the Fed's dovish shift in the future interest rate decisions, even as other macroeconomic data continue to show resilience. RBC capital market strategist Blake Twin and said Powell's attempt to convey the Fed's determination to continue fighting inflation and fight financial sector by providing liquidity. But the actual tone softened that the interest rate path will be more sensitive to the plight of the banking sector. Other analysts said given that the possible credit crunch from the banking crisis has yet to fully happen, the market will choose to ignore stronger data such as employment and inflation in the short term. The dot plot, which reflects the officials' interest rate expectations, remains unchanged at 5.1% this year, suggesting that the Fed admits that it is difficult to make any solid forecasts as the banking crisis is now rapidly evolving. In addition, the change in Treasury yields suggesting that it is nearly the Fed's pause from raising interest rates and eventually. After the Fed's rate hike, the 5-year, 30-year yield curve ended. Closely watched the 2-year and 10-year curve narrow significantly, and the steep trend of the yield curve continued on Thursday. BMO Capital Markets line Ian Lingen, head of U.S. interest rate strategy, said, assuming that this is the beginning of the Fed's dovish shift, it will also mark the start of a cyclical re-steepening of the yield curve. The 5-year, 30-year yield spread is leading the normalization of the curve. That's all I have for today. Thank you for listening. Don't forget to subscribe and like. See you next episode.